Yeah, sure. We're seeing clearly a lot of investment going into EVs right now. Estimates of $500 billion over the next 4 or 5 years. But I think sometimes what gets lost in this conversation is the fact that, right now at least, margins on EVs are lower than on traditional internal combustion engine vehicles. And if we don't see those margins start to improve, as we see the industry trying to, hit some of the targets that have been laid out there over the next, call it 8 to 10 years, our concern is that, profitability will be hit, and that could ultimately have a negative impact on the company's credit profiles.
Would that include companies like Ford and GM because they, this is going to negatively impact their credit profiles, or are they going to benefit from their deeper pockets?
Well, certainly the deeper pockets can help, but they can only help so far. And our concern is that if we do see margins come down through that period, ultimately, if it leads to negative free cash flow or weaker free cash flow, companies might need to start to augment that with additional debt, which could actually raise debt levels. And so that's something that we're watching and want to make sure investors are aware of.
Great point. And Phil, obviously for the smaller startups, a huge question they have to face in terms of just proving that they can do this at scale.
Right. And it takes time. Scale is the key here, Kelly, and I'd love to get Stephen's perspective on this. Stephen, when you look at the big costs that are within the developing and building electric vehicles, so much focus on the battery pack and the battery cells, and we know the cost is coming down. Is it coming down fast enough in terms of when you look at it and you say, yeah, I see these guys getting to the point where this is providing the margin growth that they're hoping to get, or are you still worried that the cost is not coming down fast enough?
Well, certainly scale helps, and that's definitely something that's helped the industry over the last 5 to 10 years. But I think one of the concerns that we have now, though, is with such a high level of battery demand expected, over the next decade or so, the raw materials that go into those batteries are potentially going to be in short supply. And so we'll have to see if that in some ways maybe puts a floor under just how low, battery costs can get over the next, 5 to 10 years.
Stephen, what would you say about Tesla, which has at least had 10 years to work on this with a host of sort of original and innovative production ideas they're trying to use to make this more doable?
Well, Tesla certainly showed the world that there can be, a market for, electric vehicles on large scale. And it's really driven a lot of what we've seen, I think, throughout the global industry, during this transition period. That being said, though, if you think about Tesla, really, there's still sort of luxury vehicles, right? The cheapest Tesla that you can buy is the Model 3, and it's still north of $40,000. As we think about, other manufacturers, trying to produce cars at scale at lower price points, again, if a battery pack costs, say, $10,000, that could certainly be, a concern for margins if you're trying to produce a car that's, say, sub $30,000.
Yeah, I think their Model 3 is now 45 after the price hikes in just the past few months alone. Stephen, thanks for your time today. We appreciate it. Stephen Brown, Phil LeBeau, thank you very much for bringing us that interview and discussion.